The Chapter 3 review problems are going to be exercise 3.4 and 3.7, which are similar to what's in the book, not exactly the same. And then exercise 3.2, the information for it is in the book, and exercise 3-12 is directly from the book. Exercise 3.4, here's the following information. December 31st, the post-closing trial balance for iTude Corporation. So they've reset all of the temporary accounts to zero, and these are the assets, liabilities, and updated equity accounts. We need to prepare a classified balance sheet for iTude Corporation at December 31st of year one. So this is where we're going to be classifying assets and liabilities in their different categories. So given the information, we start with our assets. Remember, we have current assets, investments, property, plant, and equipment, intangible assets. The first category are current assets. These are assets that will be used up or collected within the coming year, by the end of year two. So we have to look through our list of assets and decide which ones meet this criteria. And the most common ones are cash, and cash is always listed first because current assets are listed in order of liquidity, financial liquidity, those that could be quickest or quickly converted into cash. The quicker it can be converted to cash, the more financially liquid it is. Then accounts receivable, marketable securities if they're considered short-term, which is the case here. Sorry about that. So the marketable securities are always next because they could be sold very quickly. Then accounts receivable. So marketable securities that are short-term are current assets. Inventories, and then prepaid rent. Those are the only assets that fall into this category. So the total current assets were added up, 188,125. Next are any long-term investments. There are none. So if there were marketable securities long-term, land not used in the business, bonds held long-term, that's the kind of assets that would be in the long-term investment section. If there is none, you don't even need to list it. The next area would be property, plant, and equipment, which is where we report tangible assets that we use in the business more than a year. So this company has machinery. We list it at its balance or its cost. Remember, we then subtract any accumulated depreciation related to that asset or the amount that has been expensed so far. And it's the net or book value that is the final amount reported. So we subtract the 11,825 from the 155,875. So the total amount in property, plant, and equipment, 144,050. The next type of asset is an intangible asset. These are assets that don't have physical form but earn revenue for the company. Things like patents, trademarks, copyrights, licenses, franchises, goodwill. And this company has one intangible asset. It's a patent. And it's at a value of 89,225. Okay, so those are all the assets. We total those three numbers together to get an overall total asset. We're done reporting the assets. So now that's how you classify the assets. Current, long-term investments, property, plant, and equipment are intangibles. Then we go to the other side and we report liabilities and shareholders' equity. We only categorize liabilities between current and long-term. Current liabilities are liabilities expected to be paid off in the coming year. So your traditional current liabilities are accounts payable, because they're usually due in a very short period of time, wages payable, and taxes payable. Now the bonds payable is a liability, but that's not due for 10 years, so that is not considered a current liability. So the three liabilities that are current will be totaled and their total are $47,300. We then will report the bonds payable. Now, usually companies label this as long-term debt or long-term liabilities, and I would appreciate you doing that. But they are listed separate to set them apart from total current liabilities. There it is. Okay. We add the long-term liabilities to the current liabilities to get total liabilities. So now you've classified the balance sheet with respect to assets and liabilities in their proper categories based on common characteristics of that category. The final area is same old shareholders' equity. Remember, we have two distinct components. Common stock, where we report paid-in capital, and that's where we store the amounts received when a company first sells their stocks. And then retained earnings, which is the earnings that are still in the business available to the shareholders for a dividend. Total shareholders' equity, $159,100. We then add together our liabilities and shareholders' equity, and they should equal total assets. So that was a great exercise to go through to review those major components of the classified balance sheet and get back into it. The second exercise we're dealing with is exercise 3.7. In this one, they give us this following balance sheet information, and they tell us they've recently was prepared by a recently hired accountant, and there's some errors. We need to find the errors and correct them. Here's some more information. Cash includes a $21,050 restricted amount to be used for the repayment of bonds payable in 10 years. The cost of the machinery is $148,700. Accounts receivable includes a $19,000 note from a customer due in year 9. The notes payable includes accrued interest of $48.46. Principal and interest are both due next year on February 1st. We're now in year 6, so they're talking next year. The company began operation in year 1. Income less the dividends since inception of the company totals $69,567. And 46,000 shares of no par common stock were issued in year 1. 92,000 shares are authorized. So given that information, let's correct this balance sheet and create a classified one. Starting with the assets. First of all, current assets. In the cash balance of $42,050 or $42,100, half of it, or $21,050, is restricted. So we can only report the unrestricted amount in cash, which is $21,050. That's considered the unrestricted. Accounts receivable net is going to be $19,000 less. Let me see. So there's 76,000. Sorry, just give me a moment. I'm missing something. Oh, okay, there it is. Down below where it says liabilities and shareholders' equity, you see it says allowance for uncollectible accounts. That should actually be subtracted from accounts receivable because that's the part of accounts receivables not expected to be collected. So 76,000 minus the 4750. Also in number 3, it says there's a $19,000 note receivable included in accounts receivable. Well, that shouldn't be included, so subtract that as well. So accounts receivable net is $52,250. The inventory, there's nothing wrong with it, so we just list it. So those are all the total current assets. So we will add them up and write down our total of $124,300. Doesn't appear to be any kind of long-term investments. Oh, maybe there is. As a matter of fact, there is. The note receivable that's due in 3 years, that's a long-term investment, as well as the restricted cash. The restricted cash, since it's going to pay off a long-term liability, is a long-term investment. Okay, it's paying off a bonds payable in year 10. So that bonds payable is going to be long-term. So the restricted cash is long-term in the investments category. The note receivable is due beyond 1 year. That's long-term investment as well. So now we've seen some examples of investment items that would be in the investment category. Then we list our property, plant, and equipment. Remember, we have to list it at its cost. So the machinery's net is $122,000. They tell us the cost of the machinery is $148,700. They tell us that number 2. So the difference is the accumulated depreciation portion. So we had to figure that out and report it appropriately. So the net property, plant, and equipment category is $122,000. Last, we're going to report our franchise. Now, franchises are okay to report without cost and accumulated in amortization. As a matter of fact, any intangible asset, you have a choice. You could report it just at its net, so that would be cost minus accumulated amortization, or you could list out cost and specifically have a line for accumulated amortization. It's really your choice, your preference. So we're going to list the franchise at its net. So the total assets are $319,150. On the liability side, current liabilities, let's see. There's accounts payable, and there's nothing wrong with that number. There's interest payable. Now, it tells us in number 4, the notes payable includes accrued interest of $48.46, and they're both due February 1st. We don't report those two accounts together. So we're going to back out the $48.46 and report that separately. Then we'll report the notes payable at just its principal, or $48,454. So if you took the $53,300 minus the $48.46, you'll get the $48,454. So that notes payable balance included both. We don't report both together on a balance sheet. I think that's all of our current liabilities, unless I'm missing something over there. Nope, that's it. So total current liabilities are $101,800. We then show our bonds payable in the long-term category because they're not due until year 10. They tell us that in part 1. Their balance is $113,000. There's no errors there. Add those two together. Total liabilities are $214,800. Okay, so we've properly reported our assets in their proper categories and corrected any errors with how they were reported. Same with the liabilities. Let's take a look at shareholders' equity. Total shareholders' equity is $104,350. Well, we know we have to report it by common stock and retained earnings. So retained earnings, they tell us, is $69,567. Everything's been updated already. And common stock would then be the difference, $34,783. So we had to back into the common stock amount. Okay, so after we do that, we would then come up with our total liabilities, $319,150. Oh, and shareholders' equity, sorry, total liabilities and shareholders' equity, $319,150. So that was a great exercise to revise an incorrect balance sheet. Exercise 3.2, they just want us to do some categorizing. So there is the answer key, and we'll just run through them quickly. They want to know where on the balance sheet each of these items would appear. So equipment would be C, property, plant, and equipment. Accounts payable would be F, current liabilities. The allowance for uncollectible accounts will be a reduction to accounts receivable in the current assets section, A, and you can see there's a little minus sign to indicate that. Land held for investment, so you're not using it in your business, you're just holding on to it, seeing if it'll go up or down in value. That would be B, investments and funds. So that's your long-term investment area. Notes payable due in 5 years would be G, long-term liabilities. Deferred or unearned rent revenue for the next 12 months would be in current liabilities, F. A note payable that's due in 6 months would be a current liability. Income less dividends accumulated would be I, retained earnings. Investment in XYZ Corp, long term, would be an investment. B, investment in funds. Inventories are current assets. A. Patent would be categorized as an intangible asset. D. Land in use. Now, if you're using it in your business, that's a property, plant, and equipment category. C. Accrued liabilities. Those are current liabilities. F. Prepaid rent for the next 9 months. Well, it'll be used up in the coming year, within a year, so it's a current asset. A. Common stock would be an H, paid in capital. Building that you're using, that would be property, plant, and equipment. C. Cash is a current asset. A. And taxes payable would be a current liability. F. Okay, so those are your categories. Please make sure you review those and get familiar with them and ask any questions you may have. Finally, in exercise 312, Parkman Sporting Goods. This is on page 144. It's preparing its annual report for 2018. The company's controller has asked for your help in determining how best to disclose the information about these items. So you have to indicate whether you should do a note as a summary of significant accounting policies, which is a required note. It's usually the first one in the notes to the financial statements, a separate note disclosure, or C, on the face of the balance sheet. So in A, a related party transaction is a separate disclosure note. And you'll see if you take Accounting 212, we'll be doing a financial statement analysis, and you'll see these kind of note disclosures. Depreciation method. Remember, that's where we're summarizing our accounting policies. So that's A. Allowance for uncollectible accounts will be on C, on the balance sheet. Sometimes we put a note about them, but it's on the balance sheet. In 4, a composition of investments. That'll be a separate note disclosure where we give specific information about what makes up an investment balance. Same with 5. What makes up one balance we call long-term debt on our balance sheet? Well, in a separate note, you'll list out all the loans you have. 6, how you cost inventory. That's a summary of significant policy note. A. Number of shares of common stock authorized, issued, and outstanding are on the face of the balance sheet. So you should list that information directly on the balance sheet. And then in number 8, an employee benefits plan will be a separate disclosure note. So just getting some familiarity with how we and where we report these types of information. Okay, so if you have any kind of questions, please let me know. I'm noticing P3-3. Okay, maybe I'll get P3-3 loaded up on here, and I'll do the voice for that too while we're doing this. Okay, in problem 3-3, the following is December 31st post-closing trial balance for Amway Corporation. The investment account, they give us some additional information in 1 through 6. So you should have already looked at this, tried preparing this on your own, and now we're going to take a look at the answer. We'll start with the information. Amway Corporation balance sheet December 31st, 2018. Label our assets, current assets. Now in the current assets, it says cash and cash equivalent. They give us some information in number 3. The cash account includes $15,000 restricted in funds to pay bonds payable that mature in 3 years, and $23,000 restricted in a 3-month treasury bill. Well, $15,000 must automatically come out because it's considered a long-term investment, a restricted cash, but long-term investment because it is being used to pay off a long-term liability. The restricted treasury bill is very liquid. It's going to be converted into cash within 3 months. So that qualifies it as a cash equivalent. It does not need to be set out on its own. So if we just change the wording here to cash and cash equivalents, all 30,000 is reported in that category. Then we have investments. Short-term investments. And number 1, it says the investment account includes an investment in common stock of another company of 30,000, which management intends to hold for at least 3 years. So that part of the investment account is going to be considered a long-term investment. So only 80,000 is short-term. Accounts receivable will be reported at 60,000, net the allowance, and this is how you have to write it in. They tell us this in number 5. Net the allowance for uncollectible accounts of 8,000. So either you write it like that or you show the gross amount of accounts receivable, subtract the allowance for uncollectible accounts, and show the 60,000. Inventories, there's nothing changed there, so they're reporting at 200,000, as well as prepaid insurance. And we know it's a current asset because it'll be used up in 9 months. You don't have to put that on the balance sheet. They're just telling us that for our purposes. So our total current assets would be totaled. Then we go to the investment category. We already said marketable securities are at 30,000. They tell us in number 2 that of the balance in the land account, 25,000 of it is for land that the company bought that they're not going to use currently. So that land is categorized as an investment. And then the restricted cash is from that restricted cash balance that's being used to pay off the bonds payable in the future. So those 3 items are listed in this category, and their total is 70,000. Property, plant, and equipment. Well, the land, remember, is $25,000 less than the account balance, so it's at 65,000. Buildings are 420, and equipment is 110. We could then subtract the total accumulated depreciation, or each one separately, to get net property, plant, and equipment of 435,000. The company has an intangible asset, patents. Its balance is 10,000, and there's no changes to it. Add up the 4 categories there: current assets, investments, property, plant, and equipment, and patents to get 894,000. And guys, so you know, the current assets, the details should actually be in the column to the left and only the 379 out in that right-hand column. I think when I converted it over into PowerPoint, it changed that a little. So if you're like wondering about that, that should be over there. Okay, so let's see what happens with the liability side. Remember, current liabilities, long-term liabilities. The current liabilities start with accounts payable of 75,000, interest payable 20,000, note payable. They tell us in number 4. Here's what makes up that 130,000 balance in notes payable on our trial balance. A $30,000 note due in 6 months, a $50,000 note due in 6 years, and a $50,000 note due in 5 annual installments of $10,000 each. The first one is due in February. So the note payable that's due in 6 months is listed, and then the current portion of that installment note, the $10,000, is from a long-term debt. So it's the current amount due on a long-term debt, the $10,000 that will be paid off in the coming year. So that's how we list that off. Add them up, total current liabilities. Then we have our long-term debt. The bonds payable is $240,000, and the notes payable will be $40,000 less because $40,000 of it is considered current. So $90,000. Add those 2 together to get your total long-term liabilities. Current liabilities plus long-term liabilities, total liabilities. Now shareholders' equity. Remember what I said before? We should be listing information out about the common stock. Common stock, and they tell us in number 6. No par value. 500,000 shares are authorized to be sold. So that's the maximum they could sell. Of that, they've sold 100,000 issued and outstanding. So the total account balance is then listed of 300,000. And then the retained earnings balance of 129,000. So total shareholders equity properly reported 429,000. Add your total liabilities to your total shareholders equity, and that will agree to total assets. So that's how you take that additional information and apply it to the accounts. Okay, so make sure you go through that one on your own again. Make sure you understand it, and then you could try for the graded problem, which is very similar, P3-4. Post any questions you may have to the discussion board, guys. Thank you.